Canada's banking system is changing quietly, but what's happening right now could reshape the safety of your savings. This fall, the Office of the Superintendent of Financial Institutions, or OSFI, started easing some of the rules that have kept Canada's banks stable for decades. They call it a modernization of capital requirements. In plain English, it means banks won't need to hold as much backup cash in reserve, less safety cushion, more room to lend. OSFI's goal sounds good. Boost lending, help small businesses grow, and give the economy a bit more life after a slow year. But here's the problem. These looser rules are coming at the exact moment when Canadian households are drowning in debt and housing prices are showing cracks. Let's break this down. After the 2008 financial crash, global regulators forced banks to keep more capital, basically money on hand to cover losses if the market turns. It's the reason Canada avoided a full-blown banking collapse while others didn't. That capital rule is like a seatbelt for the financial system. But now, OSFI is saying, maybe we don't need the belt quite so tight. Here's why that could backfire. When banks can lend more aggressively, they do, especially in housing, where profits come fast and competition is fierce. That means more variable rate loans, more debt stacked on already stretched households, and more exposure if property values fall. It's not just mortgages either. Commercial real estate, office towers, shopping plazas, warehouses is a growing concern. OSFI's own 2025 report listed it as one of Canada's biggest financial vulnerabilities. Yet by loosening capital rules, regulators are giving banks the green light to double down on that same risk. So, what does this mean for you? If banks start chasing growth again, credit will flow more easily, but at a price. You'll see more too-good-to-be-true mortgage offers, more lines of credit, more pre-approved loans. But if the market turns, those same banks will tighten instantly, and borrowers will be left exposed. Remember how 2008 started with a lending boom? It always feels fine, until it doesn't. Canada's strength has always been caution. Now that's being tested. If you want to know whether this is becoming a problem, watch 3 things. First, bank earnings calls. If they brag about growing loan portfolios faster than usual, risk is rising. Second, watch for political messaging about competitiveness. That's often code for weaker oversight. And third, pay attention to consumer debt reports. When debt keeps rising, but wages don't, the system's pressure points are already forming. Here's the truth. Canada's banks are already some of the most profitable and stable in the world. They don't need looser rules to succeed. What they need is stability and trust. Because when regulators relax during uncertain times, ordinary Canadians are always the ones who end up paying the price. If this helped you understand what's happening behind the scenes, hit subscribe, share this video, and stay tuned. Because when banking rules shift quietly, that's exactly when you need to be paying the most attention.